Now speaking, Jeff Palmer, Senior Vice President, Investor Relations. Thank you for the opportunity to present NXP Semiconductors' second quarter earnings call. Our call today is being recorded and will be available for replay from our corporate website. NXP reported strong financial results for the second quarter of 2023, with revenue of $2.3 billion, up 8% year-over-year, and non-GAAP earnings per share of $1.20, up 11% year-over-year. We are pleased with our performance in the quarter, driven by strong demand across our automotive, industrial, and mobile end markets. We also saw continued strength in our new product launches, which drove higher gross margins and operating income. Additionally, we are seeing positive momentum in our new initiatives, such as our 5G platform and our automotive safety solutions. Going forward, we remain confident in our ability to deliver strong financial results and continue to invest in our long-term growth initiatives. Now speaking, Kurt Sievers, President and Chief Executive Officer. Good morning everyone, thank you for joining our call today. We are pleased to report that our Quarter 2 results exceeded our expectations. Revenue came in at the high end of our guidance, at $3.3 billion, essentially flat year-on-year. Non-GAAP operating margin was 35%, 50 basis points above the midpoint of our guidance. Our automotive segment performed particularly well, with revenue up 9% year-on-year and near the high end of our guidance. Industrial and IoT revenue was down 19% year-on-year and near the high end of our guidance. Mobile revenue was down 27% year-on-year and above the high end of our guidance. Communication infrastructure and other revenue was up 15% year-on-year and at the high end of our guidance. We experienced incremental improvement across all regions, with China gradually improving quarter-over-quarter. Year-on-year growth was led by our direct business. For Quarter 3, we are guiding revenue to $3.4 billion, down 1% year-on-year and representing sequential growth of about 3% at the midpoint. Automotive is expected to be up in the mid-single-digit % range versus Quarter 3 '22 and up in the low single-digit range sequentially. Industrial and IoT is expected to be down in the mid-teens % range versus Quarter 3 '22 and up in the low single-digit % range sequentially. Mobile is expected to be down in the mid-teens % range versus Quarter 3 '22 and to be up in the mid-20% range on a sequential basis. Communication infrastructure and other is expected to be up about 10% versus Quarter 3 '22 and flattish sequentially. We anticipate that we will maintain the 1.6-month distribution channel inventory level. We are well positioned with on-hand inventory to satiate a possible rebound in demand as it emerges. We are gaining confidence that we will be able to return to predictable year-over-year growth of the business. Demand in the automotive and core industrial businesses continues to be solid, with only a few pockets of stubborn supply shortages persisting through year-end. Within the mobile segment, we are seeing the expected strong seasonal trends in the premium portion of the market in Quarter 3. And our consumer IoT business appears to be accelerating from the trough in Q1. We are confident that we are successfully navigating through the cyclical downturn in our consumer exports businesses while we do see continued strength in our automotive, core industrial, and communications infrastructure businesses. We believe Quarter 1 was the trough in our business, and we anticipate the second half of 2023 will be greater than the first half of this year, and also the second half of 2023 will grow over the second half of 2022. We have achieved a significant milestone for the enablement of the software-defined vehicle, taping out the industry's first fully automotive, specified, safe, and secure 5-nanometer vehicle computer. This will help accelerate our automotive growth very well beyond 2024. We are confident that we are successfully navigating through the cyclical downturn in our consumer exports businesses while we do see continued strength in our automotive, core industrial, and communications infrastructure businesses. Now speaking, Bill Betz, Chief Financial Officer. Good morning everyone. Our Q2 financial performance was very good, with revenue at the high end of the guidance range and both non-GAAP gross profit and non-GAAP operating profit above the midpoint of the guidance. Total revenue was $3.3 billion, essentially flat year-on-year, while $99 million above the midpoint of the guidance range. We generated $1.93 billion in non-GAAP gross profit and reported a non-GAAP gross margin of 58.4%, up 60 basis points year-on-year and 20 basis points above the midpoint of the guidance range. Total non-GAAP operating expenses were $771 million or 23.4% of the revenue, which is up $47 million year-on-year and up $43 million from Q1. This resulted in a non-GAAP operating profit of $1.16 billion and non-GAAP operating margin of 35%. Non-GAAP interest expense was $73 million, with non-GAAP income tax provision of $180 million, reflecting a non-GAAP effective tax rate of 16.6%. Non-controlling interest was $6 million. Stock-based compensation, which is not included in the non-GAAP earnings, was $102 million. This resulted in a non-GAAP earnings per share of $3.43, near the high end of the guidance range. We repurchased $302 million of our shares and paid $264 million in cash dividends, returning $566 million to the owners in the quarter. Days of inventory was 137 days, an increase of 2 days sequentially. Days receivable were 29 days, down 2 days sequentially. Days payable were 63 days, a sequential decrease of 5 days. Cash flow from operations was $756 million. Net capex was $200 million or 6% of revenue, resulting in non-GAAP free cash flow of $556 million or 17% of Q2 revenue. For Q3, we anticipate revenue to be $3.4 billion, plus or minus $100 million. At the midpoint of our revenue outlook, this is down about 1% year-on-year and about up 3% versus Q2. We expect non-GAAP gross margin to be flat sequentially at 58.4%, plus or minus 50 basis points. Operating expenses are expected to be $785 million, plus or minus about $10 million. Taken together, non-GAAP operating margin will be 35.3% at the midpoint. We expect non-GAAP financial expense to be $67 million and non-GAAP tax rate to be 16.6% of profit before tax. Non-controlling interest will be $4 million. This implies a non-GAAP earnings per share of $3.50. We remain focused on driving non-GAAP free cash flow margin to greater than 25%, and we continue to be active in repurchasing our shares. Wells Fargo Securities analyst Gary Mobley inquired, "What metrics are you using to measure the success of your distribution channel sellout, and how has that impacted your inventory by $500 million? Kurt Sievers replied, "Good morning. We saw an increase in our distribution performance in the second quarter, which is why I mentioned in my prepared remarks that we saw a trough in our consumer exports businesses. However, we have not seen a rebound in China yet, which is the main trigger point for us. This would be relevant to both our Android handset business and our consumer-exposed IoT business. We are currently forecasting a strict 1.6%, but if we see a rebound in China, we may move higher and deliver more revenue." Wells Fargo Securities analyst Gary Mobley inquired, "Kurt, based on the breadcrumbs you dropped, is it reasonable to expect flat sequential growth in the fourth quarter or is there a possibility of growth?" Kurt Sievers replied, "Gary, I can confirm that the second half of this year will be larger than the first half. We anticipate that it will also grow over the second half of last year. Our growth is driven by two key factors: strength in our automotive, core industrial and communications infrastructure businesses, and a recovery in our consumer-exposed businesses from the trough we experienced in Q1. As for the fourth quarter specifically, we'll have to wait and see how that goes." TD Cowen analyst Joshua Buchalter inquired, "What is the current status of the inventory issues at Tier 1s in the auto business?" Kurt Sievers replied, "Good morning, Joshua. We previously mentioned that some European auto Tier 1s had over-inventory. This is reflected in our guidance. Lead times have largely normalized, however OEMs are asking for stricter inventory targets from the Tier 1s. This has created a tense situation between the OEMs and the Tier 1s, which is further complicated by the leftover inventory from the past 2.5 years. The situation has normalized relative to what we said last time, but it is still an unstable situation." TD Cowen analyst Joshua Buchalter inquired, "Can you confirm that the target inventory rate of 95 days is based on sell-through greater than selling in the back half of the year? Are you confident margins can remain at this level with utilization rates in the 70s? Bill Betts replied, "Yes, Joshua, utilization in Q3 is expected to be in the mid to low 70s. We anticipate improved mix and higher revenues to offset those utilizations. Inventory is expected to go down from a days standpoint internally, assuming the channel stays at 1.6. We're holding 25 days of extra inventory internally on our balance sheet, which is more normal than the 95-day target we set 1.5 years ago. This allows us to churn orders inside the quarter under lead times and upside revenue. The team has done a great job with this over the past 2 quarters." Deutsche Bank analyst Ross Seymour inquired, "Kurt, what are the supply and demand dynamics of the automotive sector? Are you still limited by supply? How have content gains impacted the sector?" Kurt Sievers replied, "Thanks, Ross. The automotive industry is surprisingly good. The SAR forecast at the beginning of the year was 3%, but now it's up to 5%. We expect 1/3 of global sales to be hybrid or electric vehicles, which is a 31% year-on-year growth in absolute terms. The supply chain has normalized and our trailing 12 months growth is currently at 12%. We don't expect to see the mathematical formula of SAR plus content increase in any quarter, but with more normal lead times, things are in the right place." Deutsche Bank analyst Ross Seymour inquired, "Bill, what impact does the mix of your segments have on gross margin? Are there any changes in the mix that could affect gross margin going forward?" Bill Betts replied, "Thank you, Ross. Our Q2 gross margin guidance was slightly better than expected due to product mix. Distribution sales were up to 51%, which is higher than the 48% we saw previously. This is due to the long tail of higher margin, lower volume customers. We expect to remain at the high end of our gross margin model of 58%, plus or minus 50 basis points in Q3. Longer term, we plan to focus on growing our long-term customers and new product introductions, which should help us expand our gross margins above current levels. AllianceBernstein analyst Stacy Rasgon inquired, can you explain the discrepancy between distri sales not increasing but the months of inventory remaining flat? What assumptions are you making about sell-in and sell-out in Q3 to keep inventory levels steady? Bill Betts replied, Stacy, sell-in and sell-through were both up in Q2, which is how we balance the 1.6. We anticipate our distribution sales to be up again in Q3. AllianceBernstein analyst Stacy Rasgon inquired, what evidence do you have that the recent increase in sell-through is not a recovery? Bill Betts replied, our outlook is that we will see a steady recovery, not a sharp rebound, in the Chinese market. We are monitoring the situation closely. AllianceBernstein analyst Stacy Rasgon inquired, could you please explain how reducing foundry purchase orders helps to control internal inventories? Bill Betts replied, we have seen a decrease in our purchase orders and internal utilization as we adjust our inventory levels to meet real demand. We are currently operating at a utilization rate of around 90%. This is a normal business practice and allows us to maintain an accurate inventory level. AllianceBernstein analyst Stacy Rasgon inquired, how are you achieving higher gross margins despite lower utilizations? Bill Betts replied, I believe the combination of tailwinds and headwinds offset each other in terms of internal utilization. Our factory footprint has a much lower fixed cost structure than in the past, with 60% of our products sourced externally. The quality of our portfolio has improved, resulting in a lower distribution rate. All segments are close to the corporate average, so product mix is not a concern. We are focused on free cash flow and have 25 days of distribution inventory, with the potential to add another 5 to 10 days internally. This should help us support our long-term growth. Bank of America Merrill Lynch analyst Vivek Arya inquired, Kurt, how does content differ in hybrid/EVs versus traditional ICE cars? What impact has this had on automotive sales growth, considering pricing and content tailwinds? Kurt Sievers replied, thanks, Vivek. Our exposure to electric and hybrid vehicles is highly accretive to NXP. We provide products specific to the electric drivetrain, such as battery management and gate drivers for inverter control, as well as other products that are pulled into electric vehicles due to their increased electronic features in the ADAS and body and comfort world. It's important to note that you can't compare a single quarter's SAR to our revenue, as the products we ship now were likely shipped 2 quarters ago or longer. This is due to the deep supply chain in automotive, which has caused drama over the last 2.5 years. Now, however, the supply chain is stabilizing and we are in a position to have longer-term demand and supply assurance programs with our customers, providing us with greater forward visibility on our revenue stream and required products. Bank of America Merrill Lynch analyst Vivek Arya inquired, Kurt, how have customer discussions changed as the automotive supply environment normalizes? Are they less willing to accept higher prices and take on inventory? Kurt Sievers replied, our pricing follows the increased input costs, and unfortunately, we expect these costs to remain high this year. We anticipate similar trends for next year, though a few elements in our input costs may be better. Our product, especially in automotive, is unique and not replaceable on the short term, so there is no risk of it being treated as a commodity. We have long-term agreements with our customers that provide both demand and supply assurance, which helps avoid short-term fluctuations. UBS analyst François Bouvignies inquired, Kurt, what changes have you seen in automotive orders recently, and how does that affect your outlook for the sector? Kurt Sievers replied, thanks for the question, François. We never worked on a backlog of pent-up demand. Instead, we have NCNR agreements with our customers to better understand true demand over an extended period of time. There is no negative or positive impact from working down a backlog. The macroeconomic environment is uncertain and there are concerns about consumer behavior, but third-party research companies forecast a 5% growth in SAR this year. Dealer inventories in China and the US are lower than their long-term averages, while in Europe they have normalized. Overall, auto consumption is not in a bad shape. UBS analyst François Bouvignies inquired, what is your view on pricing pressure from local Chinese competitors and how much of your business is low-end versus high-end? Kurt Sievers replied, we are seeing some pricing pressure in the low-end market controllers in China, which we have anticipated for some time. We are still engaging with our distribution partners and end customers there, but this is not an area where NXP wants to be competitive. Our business philosophy is to differentiate ourselves through product value, performance, and specifications. We do have some exposure to commoditization, but it is quite small as we do not compete on price. Evercore IC analyst CJ Muse Inquired, Kurt, could you discuss the trends you're seeing in China and any potential green shoots for Neo and BYD or Android? Kurt Sievers replied, thanks, CJ. I don't see a rebound in our numbers or remarks, but we do feel that the over-inventory of Android phones with our customers has been worked down. This means that if there is an increase in consumer demand, we will be able to meet it. We also have good exposure to electric car companies in China, such as BYD and Neo, which are growing their market share. Our portfolio of newer products in these companies allows us to benefit from their success more than competitors from the West. Finally, our consumer IoT business in China has seen a gradual increase from Q1 to Q3, but it's not yet strong enough to justify refilling the channel. Evercore IC analyst CJ Muse inquired, are Tier 1 foundry prices weakening, and is this loosening up wafer pricing in any of your markets? Kurt Sievers replied, I can confirm that Tier 2s have exhibited the behavior you mentioned. However, it has not been beneficial for us as most of our Tier 1 and core industrial and automotive customers do not want product from these sources. We have not seen any signs that this will change for the Tier 1 foundries. Barclays analyst Blaine Curtis inquired, could you quantify the pressure from rising input costs, both external and internal, and when will it start to affect your operations? Kurt Sievers replied, input costs from Tier 1 foundries have increased significantly for the past 2 years, resulting in our company having to raise prices to customers in order to protect our gross margin. Unfortunately, there has been no indication that these Tier 1 foundries will reduce their prices, although Tier 2 foundries have reduced theirs considerably. Barclays analyst Blaine Curtis inquired, Kurt, what is the normal range for lead times on all your products? Kurt Sievers replied, most of our products have normal lead times. However, we have a few remaining nodes from both internal and third-party foundries that are in severe shortage. This is a small portion of our total revenue, but it is still a big problem for customers who are missing out on these products. We expect this issue to be resolved by the end of the year. Additionally, a good portion of our business is under mount in our contracts, which have a lead time of 52 weeks by definition. Kurt Sievers replied, in summary, Q1 saw us leave the trough of consumer-exposed businesses behind us and we are seeing good incremental growth from there. Automotive, home infra, and core industrial remain strong and we are confident to maintain our resilient margin pattern at the high end of our long-term guidance. Thank you for joining the call and I look forward to speaking with you again soon.